In the world of investing and trading, risk is not merely a concept of or to be feared or avoided. Instead, it is essential component of potential returns. Yeah. So risk, many people think that there's a lot of risk. So whether we should invest here or we should trade this instrument or not. Okay, understand risk is always there. Okay, even if there's no return, if you are investing or if you are putting your money somewhere, there is a risk. Even if you are keeping your money under the bed, still there's a risk of it getting stolen, right? So risk is always there. You cannot avoid risk. Okay, you can reduce it. Reduce it. You don't need to be fearful of risk. Okay, but you should know that tools how you can reduce it. Okay, avoiding is not the correct method of mitigating risk. Okay, uh, dealing with risk is very very important, and that is what we should focus on than avoiding risk. If you avoid risk, then returns will also be avoided. Okay, because risk and return are interconnected, right? Instead, it is essential component of potential returns. Understanding this fundamental relationship is crucial for developing effective investment strategies. Okay, so this is very important that risk and returns are connected. If your risk is zero, then your return will also be close to zero only. Okay, so you have to take risk. Okay, and there's no problem is taking risk. There's no harm is taking risk if it is a calculated risk, and if you know that this is the maximum what I can lose, right? If you know that and you can manage risk, then there's no issue. Just as a farmer must plant seed and risk their loss to grow crops, investor must put capital at risk to generate returns. Okay, so farmer, if you see, a farmer buys seeds, okay, to grow the crops, right? If we say that okay, my crop may be eaten away by animals, or maybe rain may not come in, and I will not grow crops, I will not put seeds. Okay, so he is not investing in the seeds, but his returns are going away also. He cannot grow crops, and if he cannot grow crops, he cannot sell it, right? So you cannot just say that okay, I will not plant seeds. Okay, you have to plant seeds to get the crops, right? For example, consider two investors, one who keeps all their money in cash under their mattress, says zero risk, but also zero return. So here your risk is zero, but your returns also zero, right? In fact, your risk is actually not zero because it can be stolen away, right? You cannot always sit onto it, right? And another who thoughtfully invest in the diversified portfolio, and another investor who invests in a diversified portfolio in a proper manner, managing risk. Okay, that he will have at least some returns, right? Although the risk will always be there. While the first investor avoids all risk, they also guarantee their wealth will be eroded by inflation over time. So although if you don't take any risk, okay, still you are at risk because inflation is always there, right? So inflation will eat up your returns, and ultimately your capital will erode. Meanwhile, the second investor accepts a measure of risk in order to generate potential profits or returns. So the second investor is accepting risk, and he is careful, and he plans accordingly and manages risk. Okay, then he may get profits, right? He may get more profits than obviously that person who has not invested at all. Every trading style has losing streaks that will ruin an investor for being trading in the wrong time, or is undercapitalized. So there's no way that there won't be a losing streak. There's no way that there won't be risk. Okay, these things will come. Okay, you cannot avoid them. Okay, but that doesn't mean that you are careless about them, right? You should know that this thing will happen, and you should be prepared for it. Yes, so that whenever it happens, it hurts you less, right? It hurts you to the extent that you can tolerate it, right? You should not be undercapitalized. You should not be like taking undue risk, like liquidity risk, or going into asset classes which are very very illiquid. Okay, so unnecessary risk you are not taking, but wherever risk is required, you are ready to take it. Therefore, the size of the position, the markets to trade, and when to increase or decrease leverage becomes important for financial survival. So because of this, say the size of your portfolio, or the size of your position in the portfolio will be important, right? How much you're investing, which instrument, okay, which market you are trading, whether it is liquid, whether it is not liquid, okay, which instrument you are trading, which time frame you are trading. So all these decisions will depend upon your risk, and risk will depend upon these decisions, right? And that will tell you whether you'll survive in this market or you'll perish, right? And how you can manage your leverage, right? Leverage is a two-edged sword. It can kill you also, and it can give you exceptionally good returns also, right? So you should know how to use it. Otherwise, it will you will cut your own throat with it. Some risk, called unsystematic risk, can be controlled or reduced, while market risk, which can take the form of a price shock, can never be eliminated. So there are some risks which are unsystematic risks, which can be controlled by diversification, by measures of, say, controlling position size, or by other means of liquidity, right? But there's some risks which are systematic risk, which are market risk, which are always there. Like, say tomorrow something happens, and say Modi dies, okay, then obviously the market will have at least a short term effect on it, right? So such risks you cannot avoid, which are called price shock risk, okay, which suddenly something happens, say a tsunami comes in, earthquake comes in, where it can happen to anybody, right? So that can never be eliminated. So but still, if it happens, your position size is such that it doesn't affect your it doesn't affect substantially to your portfolio. It will affect to your portfolio, but it doesn't affect substantially to your portfolio. That is what you have to make sure. The inseparable nature of risk and reward. The risk and reward are intrinsically linked in a relationship that defines every investment decision. So the risk and reward obviously are interconnected. We have understood that, right? There is a relationship. The risk increases, the return also increases. The return increases, the risk also increases, right? But it's not always the same. Okay, it's not necessary that the returns will increase in the proportion of risk increasing. Say if the returns increases from say 100 rupees to 1000 rupees, it's not necessary that your risk will also increase from 100 to 1000, right? It may possibly increase from 100 to 200, right? So that proportionally can be managed. Okay, that is what you have to do basically. Being a risk manager or being a portfolio manager, that is what you have to do. That your returns are increasing, but the risk is not increasing in the same proportion as the returns are increasing. If you can do that, then you'll be a good portfolio manager. This connection is not merely in a correlation; it is casual relationship where the potential for higher returns necessarily requires accepting higher level of risk. Yeah. So it's this relationship is not, you cannot gauge it by correlations. Okay, it is basically a cause and effect relationship where the risk is there, then return is there, and then return is there. That is why the risk is there. So it is a cause and effect relationship basically. By attempting to eliminate risk entirely, we inevitably, inadvertently eliminate the possibility of meaningful returns. So if we eliminate the risk totally, then our return potential will also almost be zero. Here are some real world examples. Say, for example, these are different, say, asset classes or instruments, right? where you can see the return and the risk are proportional to each other. Government bonds typically will have say 2 to 6% generally returns. Right, in India it will be 6%. In US generally it is up to 4-5% annual returns. But the risk is also minimal, right? Because it's government backed securities, right? If you see blue chip stocks, they may give you little higher returns. In you, this everything is basically from US, so they are talking in numbers in US. What is there? Okay, in India it will be little higher, but in US generally, if you invest in blue chip securities, you'll get near to 8 to 12% annual returns. But the risk will also be more than the government bonds, obviously, right? But it will not be as high as the small caps or the mid caps, correct? Small cap stocks will obviously have higher potential returns. You can expect 50 to 25% annual returns, but the risk will also be higher, right? No, it cannot be same as blue chip stocks, or it cannot be same as government bonds, right? And if you invest something like an early stage startup, then obviously your returns can be much higher, uh, maybe in thousands of percentages. Okay, but your risk is also high because the failure potential is very high. If you see startups, out of 10 only one or two startups will perform good, right? So as the risk increases, your returns also increases. They have some relationship at least, right? Embracing risk strategically. Success in investment comes from not from avoiding risk, but from understanding that and managing it effectively. So this we have discussed again, that we can avoid risk, but we have to manage it. Okay? We have to understand risk and then manage it. That is a better way of doing it. Strategic risk management involves several key components. Okay, so there's some things which we can do, right, to reduce risk. So some of these are listed here. Position sizing. All right. Say basically, if you have a portfolio, okay. Now let me show this on Excel. Okay. Okay. Suppose you have a capital of say uh, 1 lakh dollar or 10,000, 1 lakh rupees, whatever it is. Okay. So suppose we start with say 1 lakh, or let's take it for simplicity purpose. I'll take it say 1 million, or that is 10 lakhs. Okay. So suppose your capital is 10 lakhs or 1 million. Okay. And say you want to invest in 20 stocks. Okay, you want to keep, say you want to have a concentrated portfolio, or say let's say 10 stocks. Okay, so you want to have a concentrated portfolio. Many people talk about concentrated portfolios give you get better returns, right? Like Warren Buffett advocates that. Because suppose you are putting say 10 stocks. Okay, so number of stocks is 10, right? So if you are say equally weighting each stock, say as of now we'll take a simple example of equal weight. Okay, so equal weight if you do in each stock, then what will be there? So each, if you have 10 stocks, 10 lakhs divided by 10 will be 1 lakh rupees for each stock, right? Each each stock will have invested, will invest 1 lakh rupees. Now say if this stock goes down by 50%, for example, just for example, okay, if it goes down by 50%, then we will lose 50,000 in this, right? We'll lose 50,000 in this, right? Then what happens? This 50,000 divided by 10 lakh, which is our original capital, multiplied by 100. Okay. So our risk is 5%, right? Okay. A risk. This is the risk, right? Now, if I change this 10, okay, to 20 stocks, right? If I change it to 20 stocks, okay, I'll make this as 50% off. Okay, so by just increasing the number of stocks from 10 to 20, you're investing now. Say here you were investing. This was say, 10 again. Okay. So you were investing how much percentage? 1 lakh divided by 10 lakh. Okay. So you are investing 10% in each stock. Now by investing 20%, 20 in 20 stocks, you're investing 5% in each stock. Now your risk is 2.5%. Right. So even if the stock goes down to 50% of your portfolio, you are still losing 2%, 2.5% of your portfolio, which will not hurt you too much. Correct? Right. So even if stock goes down to 50%, you will not be hurt. But yes, if the entire portfolio goes down to 50%, every stock goes down 50%, then it will obviously hurt. That we're not talking about. Okay. But in 20 stocks. But if you invest in say 30 stocks, then what happens? Now you're investing only 3.33% in one stock. So now your risk, even if the stock goes down by 50%, your risk is only 1.6% or 1.7% of your entire capital. It will not hurt you if one stock goes down suddenly by say 20, 30, 40%. Right. And same way, if you make it 50 stocks, okay, then you only invest 2% in one stock and your risk is 1%. Now you will say, okay, if I do that, then my returns goes down, right? Your return potential goes down. Yes, it will go down, but your risk substantially goes down. And always understand one thing: in this market, your purpose should not be to make money. You will make money. Believe me, if you stay in the market for 10 days, 10 years, 20 years, 30 years, you will make money. Okay. The question is whether you will survive for 30 years. Okay. If you can survive, you will make money. Maybe even if you make money by say 15%, which is your basic return of say the index of say at least Indian index Nifty gives you 15% CAGR returns, has given in the last 20 years. Okay, so even if you make 15% return, still with the 10 lakh rupees of starting capital, you will be a millionaire. Yeah. Your at least this is my way of thinking, and this is how I think about it, and I do my trading, is that I have to survive for 30, 40, 50 years. If you survive with even with 15% return, you will be a millionaire. Ultimate, even with 10 lakh rupees, even with 5 lakh rupees, you will be a millionaire. Okay, and you can do your math. Okay, there are calculators where you can do it. If you start with say maybe I think you will get it. Uh, invest by calculator, right? Any investment calculator you take, say you start with say 5 lakh rupees basic, right? Okay, after say 30 years, I'll not take 50 years, let's take 30 years, and return is say 15%, which is this at component I'm taking this additional, I'll take zero. Okay. Just at the beginning. Okay, calculate at the okay, and calculate. Okay. You can see this 5 lakh in 30 days with a 15% return annually. Okay. Is how much? This is the return. Okay. This is how much? Anybody can tell me? I'm bad at numbers. Okay. 3 crores. Am I right? 3 crores, 31 lakhs.
3 crore 31 lakhs.
Correct?
Yep.
Right? 15% is the bare minimum I'm taking of Nifty returns. Okay. And we don't beat Nifty, suppose. If I take that. Okay, so that is why I'm saying that your purpose should be to survive. Okay, you will be a millionaire with 5 lakh rupees also, and I'm sure most of you will have 5 lakh rupees in your pocket, and maybe not night round, but going forward, if you do any job in 1 year, you will make 5 lakh rupees, right? So that is what we mean by position sizing, that uh, you survive with taking 50 stocks in your portfolio. Believe me, I will show you, and I must have shown you in level two. Most of you were there with me in level two, right? With a basic strategy, which I've shown you with moving averages also, with RSI also. Okay, you can easily get 20-25% CAGR. Okay, with 50 stock in a portfolio, you can still get 25% CAGR. And if I change this 15% to 25%, okay, then I think your mind will blow out. Okay, how much it is? 40 crores. 5 lakh becomes 40 crores in 30 years with a 25% CAGR, which is very much possible. Which is very much possible. If you are a good technical analyst, okay, you can do 25% CAGR. I'm not talking about 100%, 50% CAGR. People run for these 100% returns or 200% returns or 50% returns in a year. Okay, uh, it's meaningless for me. I don't know why they do it. It's very very difficult to get those returns. But 20%, 25% CAGR is very doable. I'm sure in the last 4 years, many of you must have actually achieved it also, right? Position sizing, never risking more than a few percentage of your portfolio on any single trade. Yeah. You should never invest in one single trade or one single stock or instrument too much of your capital. Okay. uh, Say people try to say make money fast. Okay, they want that, okay, if I have only one stock and if it doubles in 1 year, my return is 100%. Okay, but you also have to think that that one stock has a very high probability of going down to zero also, or going down by 70-80%. Like many stock in the last 3 to 6 months have gone down by more than 40 to 50%. We have seen that, right now, if you see. Okay, so your risk is also that much, right? Your risk is also, you are taking 50 to 60, 70, 80% return. I mean 100% return can happen, right? 100% return, risk can happen, right? Your entire capital can go eroded because one stock can go down to zero, correct? But if you have a portfolio of say 50 stocks, okay, few stocks will go down to zero also, few stocks will go down to 50% also, but your entire portfolio will not go down by say 100%, right? Diversification, spreading investment across different sectors, asset classes, and geographies. So diversification doesn't only mean in multiple stocks, but it can be also to different sectors, to different asset classes. Like you can invest some percentage in equity, some percent in bonds, some percent in real estate, some percentage in say commodities like gold, silver. Okay, even some percent in cryptocurrencies. Okay, so diversification will reduce your risk. Okay, return will also reduce, no doubt about it. But as I said, your first purpose has to be survival. If you survive, then you can definitely make money. Stop loss strategy, setting stops to limit potential losses. Okay, now stop losses, there are many people who don't use stop losses. Okay, there's some strategy which don't need stop losses, or they don't work well if you keep stop losses. Okay, that let's keep them aside. But stop losses are exceptionally important. Why? Because it cuts your losses early. Understand, there's a law of percentage, right? I must have shown you in level 2 or maybe in level 1 also. Okay, I'll show you again. Okay, there's something called law of percentages, right? Okay, so suppose you start with say 10 lakh rupees or 10 lakh dollars, whatever. Okay, and you lose 20%, right? So now your capital has become 8 lakhs, right? From 10 lakh rupees, you lost 20%, so you lost 2 lakh rupees. Now it has become 8 lakh rupees. Now from 8 lakh rupees come back to 10 lakh rupees. Okay, you'll have to make a return of 25% on 8 lakh rupees, right? So you lost 20%, but you'll have to make 25% to come back to the original capital. Forget the returns after that. Okay, but to come back to your actual capital, you have to make 25%. So if your losses are big, okay, each trade losses are, if they are big, then that much money you'll have to make to come back to your cost also, right? So your stop loss is say 5%, you have to just make and you cut off that trade, and you invest that money to some other stock or some other investment. You have to just make 4% to come back to your, to recover your loss of 5%, right? Sorry, you have to make some 6% or something, right? But if you hold on to it and it becomes a bigger loss at 10% or 20%, then you'll have to make 25% return, right? So understand, it becomes difficult to come back to the original value, okay, if your stop losses are big or if you don't keep stop losses. Okay, this is a basic law of percentages which most people do not understand. Okay, if you lose say 25%, then you'll have to make 33%. If you lose 50%, you'll have to make 100%. 5 lakh has become 10 lakh has become 5 lakhs, right? And from 5 lakhs you have to make another 5 lakh rupees, then you'll have to make 100% CAGR, 100% return to come back to your original capital. And if you lose say 70-80%, okay, then it becomes even more difficult, right? So if your losses are bigger, the recovery becomes difficult. So that is why stop losses help you cut your losses early so that you lose less, so that you have to, when once the market again starts to recover and it goes up, okay, you have to put less effort to come back to your original cost, and then from there on your returns will also be higher, right? If you're lost less, say firstly, say suppose you lost say 50%, okay, if the market goes down by say 50%, okay, if you would have invested 10 lakh rupees, you would have come to 5 lakh rupees. So from here, if the market comes back to the original value, say it started from say 20,000, it came down to say 10,000, and again it comes down to 20,000, you are at cost, right? But if you had cut your losses at say 16,000, say 20% from the top, you have cut your all your positions, suppose, okay, then and the market continues to go down, okay, you are out of the market at that point of time, you are say not making any money in interest, okay. But once it goes down to 50%, you enter little late also, say you enter when it is say at say 12,000 also, right? You do, obviously you will never be able to enter at 10,000 levels if that's the bottom, right? So even if you enter at 12,000, okay, still you have made that 4,000 rupees ka difference, right? And if it starts to perform from there from 12,000, you will be in profit because your loss is only say 4,000 points from the top. So 20,000 to 16,000 you exited, right? So you have to make that 4,000. So till that time market comes to 16,000, you are at cost. And then from there on, if it continues goes up and goes from 16,000 to goes to 20,000, then obviously that 4,000 profit you have made, right? So if you cut your losses early, your recovery will be faster, right? I hope you are getting this. So stop losses are exceptionally important. Uh, can't more emphasize on this. Okay, setting stops to limit potential losses, and obviously, if your losses are smaller, your recovery will be faster. Risk reward ratio, taking only taking trades with at least 1:2 risk reward ratio. So risk reward ratio is again exceptionally important because say you it's trading is like hunting. uh, Say you cannot you have limited bullets, right? You cannot shoot every now and then, right? Because your capital is also limited the same way as your bullets are limited, right? So you'll have to be very careful while hunting. You'll have to wait for your say pie to be in your sight, to be in a distance where you can hit him, okay, and then only you will shoot it, right? So that is why, so your risk reward ratio should match in that case also. Only if it is coming in your range, okay, that is where you shoot, right? And if you are say stable, like you are stable, and if you're not like running around and you're shooting, then obviously you will miss it, right? So your risk reward ratio is something like that. It's like guerrilla warfare, where you attack only when the other party is not active and not aware of you being there. Okay, suddenly you attack them, right? You surprise them, and that increases your chances of being correct. Like same thing, you have to wait for and then say shoot, right? So risk reward ratio is exceptionally important. Uh, 1:2 is good enough, but it can be much higher also. And also understand, um, in trading, your win rate in most cases will be less than 50%. So if your win percentage is less than 50%, then you cannot have a risk reward ratio of 1:1, right? Otherwise, obviously, you will lose, right? So your risk reward ratio, again, that also I'll show you. Okay. Okay. So suppose we take an example of 50% win rate. Okay. So this is, suppose your win risk reward ratio say 1:1, and this is 50-50, right? Your win and loss ratio is 50. Then you don't make anything, right? Because you made 5,000 rupees here. Suppose each trade is of 5,000. Say in each trade, on an average, you make say a loss of 1,000 rupees, and when you win, you make a profit of 1,000 rupees. Then after say 10 trades, for example, your profits from the winning trades are 5,000, and your losses from the losing trades are 5,000. So ultimately, with risk reward ratio of 1:1, you don't make anything, right? But if you increase this risk reward ratio from 1:1 to say 1:1.5, okay, so now your returns are say 1.5. Okay, your risk reward ratio remains the same. Your sorry profit percentage remains the same. Then obviously you have made a profit of 2,500 rupees, right? On a capital of say whatever. Okay, suppose 10,000 rupees profit, you have made a profit of 2,500, which is 25%, right? Now, if I increase this to 1:2, this was 1:2 or 1.5, but if I increase it to 2.2, then obviously your returns will increase, right? If I make this 2,000, and obviously your returns will be 5,000, right? Even if it is say even if your win percentage reduces, like here, if I remove one, okay, okay, if I remove this and I come to score win percent of say 40%, still you are in profit, right? You won on only four trades and you lost in six trades out of 10. Still you are in profit of 2,000 rupees, right? With a 1:2 risk reward ratio, right? But what if I make it 1:3, right? Okay. Now if you see, if I make it 1:3, it is increased to 6,000 rupees, right? So as you increase your risk, say understand one thing, that your win probability will not increase beyond a point. So if you can be right, say 60% of the time, say 70% of the time, but more than 70% of the time, it is near to impossible to be right, to make anything meaningful, because risk is always there. There will be some price shock, there will be something which will happen. Okay, so going beyond 70% win rate is close to impossible. So even if you have say a 70% win rate, okay, which is the say the max which at least I can think, okay, with that also, say if I make it, I'll make it opposite actually. I'll make it if your win rate is 70%, say for example, okay, Okay, and you lose us. Okay, so if you win in 70% race or loses only in 30% race, but your risk reward ratio is 1:1, right? If it is 1:1, okay, then you make maximum 4,000 rupees. Okay, or say in 10 trades you make 4,000 rupees, right? So you cannot go beyond this. Okay, beyond 70% is very very difficult. The only thing now you can change is your risk reward ratio. So if you can increase this risk reward ratio, okay, even to 1:1, 1.5, okay, then if you see it, it increases to 7,500. Even if you have to say lose one of the trades, so if your win rate has goes down to 60% also, it will still not matter much. Still you'll make more money, right? If there you were making 4,000 rupees, now you're making 5,000 rupees just by increasing the risk reward ratio. Even if you say have a say 70 say 70%, not 70%, uh, say 60% losing trades, okay, and you only 40% winning trades, right? But your risk reward is 1:3, then you make much more money, right? Now you make 6,000 rupees, right? So increasing your risk reward ratio is generally more possible than increasing your win probability. Okay, so focus always on your risk reward ratio. Okay, now your risk reward ratio always does not mean that you will be knowing exactly what point will be your stop loss, exactly what point will be your uh, exit point or your target. Okay, it may not, it is not required. If you have a system which is tested, you will get the data. Okay, you will know that what is your average loss per trade, what is your average profit per trade. All those things, as we go forward, we will be doing some backtesting and we'll be seeing those things. Okay, but all those things you can calculate and you will get that understanding going forward, right? So focus more on risk reward ratio than win probability. Okay, people generally do the opposite. They give more importance to win probability than to risk reward ratio. Here they have given an example. For example, if trading stocks, a strategic approach might look like this. Say if a portfolio size is set in $1 lakh, okay, or say $10,000. Okay. Then your maximum risk per trade will be $3,000. So per trade is 3%. That is $3,000. Your stop loss, say, for example, is 8% below the entry price. So that is your stop loss. Your target profit can be 16%, which is double than your stop loss, right? So, so that is how you can plan things. This is the most simplest way of showing things. Okay, as you go forward, it will become more complex. But this is for your basic understanding that if you keep your loss per trade limited, okay, if you keep your stop loss, if you keep your position size limited, okay, uh, and have a good risk reward ratio, then obviously you will, no matter what strategy you use, okay, if you follow this, okay, if you follow this, no matter what strategy you use, okay, in most cases you'll do very good. Okay, if you can follow this, okay, strategies are just one part of trading. Okay, the bigger part is this, the asset allocation, basically the position size, that is more important. The evaluation of risk tolerance. Risk tolerance actually evolves as portfolio grows in size. So one thing which is there, which has been seen, is that your risk taking capability. Okay, as you are you have a smaller portfolio, is high. Say for example, you have just 50,000 rupees, or say $5,000. Yeah. Then you can take high risk because what will you lose? 50,000 rupees. Okay, I'll take entire risk, capital as risk. Okay, I can take 100% risk, right? But can you do that with a 10 crore portfolio? You can't do that, right? Okay. You even with a say 1 crore portfolio, you won't be able to do that, right? So as your capital is small, okay, you take higher risk generally because uh, in absolute terms the risk is small, right? But when your capital increases, your absolute risk increases substantially. So you are not willing to take higher risk. Absolute risk you will not take that much, right? Following a principle similar to a law of diminishing returns. So this is basically using the law of diminishing returns. That as your capital increases, your risk capability will reduce. When a portfolio is small, investors can afford to be more aggressive because the absolute value of the potential loss is manageable. So, if your portfolio size is small, okay, then you can take a higher risk, right? As I said, but if it's big, then obviously you cannot take that big risk. Because the absolute value of potential losses is manageable and recovery from drawdown is relatively quick. So, if your portfolio size is small, you can recover also fast because, say, if you lose also 50,000 rupees, okay, you can put another 50,000 rupees, and then if you make on that 50,000 rupees, you make 100% return, you will get recover your entire money, right? Because you have to just make 3,000 rupees to come back to your to recover all your losses. But if you lose a bigger value wise, if you lose bigger, then coming back to that much and getting 100% return on a bigger capital is much more difficult than making 100% return on a smaller capital, right? However, as a portfolio grows, the psychological and practical implication of losses become more significant. So the losses will also hurt you more emotionally. Okay, if your portfolio is big and you lose on that. For instance, a 20% loss on a 10,000 rupees, $10,000 capital or portfolio, which will be a $2,000 loss, feels very different from a 20% loss on a 1 million portfolio, that is $2 lakh portfolio, right? Obviously, if you lose 20% on $2 lakh, it will be $40,000, right? Which will be more hurting to you, right? Obviously, than losing $2,000. You can do a job and you can make $2,000, right? But making $40,000 will take more time, right? Obviously, this reality often leads investors to adapt increasingly conservative strategies as their wealth grows, prioritizing capital preservation over aggressive growth. So, as the capital increases, generally the investors' mindset changes, and from growth perspective, he shifts to capital preservation. Right. Initially, you can with a small capital, you can have you will want faster growth, aggressive growth, right? But as your capital increases, you will be looking about how to preserve your capital first, and then whatever returns you make, it's always good. The shift is not just psychological; it is also practical. So this is not only psychologically evident, but it is also practically evident. This is because larger portfolios typically do not require the same aggressive growth rates to meet financial goals. So this is practically if you see, if you already have a $1 million portfolio, say 10 lakh rupees or 50 say 1 crore rupees, okay, your financial goals can be met by even 20% return or 15% return. But if you have a smaller capital, say you have only say 5 lakh rupees, then your basic financial goals, to fulfill that, you'll have to have higher return, right? Your growth rate has to be higher. If your capital is small, then your rate has to be higher to fulfill. And if you want to buy a car, or if you want to buy a house, or if you want to buy a mobile, okay, it- if your capital is small, then your requirement will be small, right? So that is what is important, right? So you don't actually need yeah, very big capital if you already have a capital, right? Generally, all your needs will be fulfilled with a smaller returns percentage as well. Risk tolerance progression. There are various stages which they've mentioned here. Okay, it is the same thing, but they've shown us starting out safe with a $10,000 portfolio can risk 5% per trade, that is $500. Aggressive growth strategy acceptable will be, so you can have an aggressive growth strategy because your capital is say only $10,000, right? And recovery from losses will be relatively quick. So if you lose, your recovery can also be faster because you can add more money, right? You can add another $5,000 and you can say recover. If you have a loss, you can recover that. But then there will be a second stage where say you have reached to $1 lakh portfolio. Okay, so now you'll have to reduce your risk. Your position size has to be smaller, right? So risk per trade reduces to only 2% of your capital. Say only putting $2,000 in one trade. Initially you were putting 5%, now you reduce it to 2%, right? And you're risking only $2,000 in one trade. A balanced approach. So you are looking for growth because it's still not that big portfolio, right? So you still want growth, but you also want preservation because if you have made $1 lakh portfolio, you do not want to lose substantial portion of it, right? So more emphasis will be on consistent returns than to have aggressive returns, or it will be moderate. Like you will not be very um, eager to make a big risk also, right? So you will need more consistent returns to grow your capital. But once you go to a $1 million portfolio, right, which is like 10 lakh dollars or something. Okay. Your risk per trade has to be reduced even further to just 1% of your overall capital. That is say $10,000. Your focus shifts directly to capital preservation. Now, once you have made so much money, you don't want to lose $1 million, right? Or you don't want to lose 50% of it, right? Right. So you will shift to capital preservation. You will have more diversification. And you can do that as your capital increases. You can have more diversification. So if you have only a portfolio of say 10,000 rupees, you will be able to buy one or two shares. So even if you buy Reliance, you'll get two shares of it. Okay, so you cannot have diversification with a very small portfolio, right? But you have a big amount, then you can buy a lot of stocks, right? You can buy more stocks, or you can invest in multiple assets, right? Then your income, then your focus is also on income generation becomes more important than growth. So you will think, okay, if I get 10% with that 1 million portfolio, with a 1 million portfolio, even if I get 10% return, it is more than enough because I'm still making $1 million, say $1 lakh per month or per year, basically, which is good enough, right? So then your focus totally shifts from growth to preservation of capital, right? Trade off of capital preservation. This table establishes a practical example of how portfolio strategy might change. So this is again the same thing. Okay, risk per trade reduces for the growth strategy. You will have higher capital. You will invest in one trade, right? So 5% you're putting here. With preservation of capital strategy, you'll just put 1% of the capital in one trade. Your expected returns generally in with when your capital is small, you will like to have higher return like 20 to 30% CAGR. Okay, but with a preservation strategy with a higher capital, even at 8 to 12% or 8 to 15% return, you should be okay with it, right? Maximum drawdown will be high in such growth strategy. It can increase to 40-50% also. But in preservation of capital, you will like to have lesser drawdowns, say 15 to 20% drawdown of your entire capital, right, which is also quite high. Many people may not even be able to take that much. Recovery period. Generally recovery period will be smaller because you can add more capital and make money, and because your if your risk is high, your return will also be generally be high. So if you're taking say making 20 to 30% returns, even if you have made say 50% drawdown with 25% CAGR return, you can recover that in 2 years. But if you have say a return of only 8 to 12%, then to recover this 15 to 20%, you will have to have say 3 to 6 months, right? Generally, your recovery period will reduce. Is a mistake here. Um, Generally, they say that recovery losses relatively quick, right? But here they're showing it that it is slower. I think this should be 3 to 6 years. I think there's a printing mistake. It should not be. But actually, if you see, if your the risk is small, you will recover faster. I'm not sure whether this is correct or not. But based on the risk percent law of percentages, recovery will be faster, right? But here they've said it recovery from losses is relatively quick for a smaller portfolio. So that is what is like not connecting here, right? Recovery period here it is more than this with the core strategy. Okay, this we'll have to check. Capital practical implication. A balanced approach might look like what we can do is that you can have a mix of these things. Also, you can have say conservative core where you put 60% into say blue chip stocks which are less riskier, government bonds which are again less riskier, and high grade corporate bonds which also have lower risk, right? So 60% you put here, and then you put 30% moderate growth, which is like mid cap stocks or real estate investments, or your emerging market bonds like Indian bonds or something like that. Okay, so where your risk is a little higher, but your returns are also higher, right? Compared to the blue chip stocks or the government bonds, right? And you can have put 10% into aggressive growth, where you can put 10% into either small cap stocks or emerging market equities, or you can have specific sectors like if you feel that defense is going to do good, then put 10% to defense. Okay, so if it does good, it will give you a big boost. Although you have invested only 10% into that sector, but it will give you a very strong boost into your capital capital growth, right? This structure allows for capital preservation while still maintaining some exposure to growth opportunities. So here, your major focus is on capital preservation because your 60% investment is in such instruments which are less riskier. Okay, but you also still have a growth opportunity. You still have a potential to grow because even if this 30 to 40% which you are putting into moderate growth or aggressive growth, if this grows by say 50 60%, then your overall capital growth will be much high, right? The key is adjusting these percentages based on your specific situation and risk tolerance. So if you are aggressive, then you can increase this aggressive growth to 20% from 10%, and this you can increase maybe you can keep it 30 only and reduce this to 50%. Okay, or if you are less aggressive, then you can increase this to 70%, make this 20%, and let it be 10%, right? So based on your risk tolerance, you can always adjust these percentages. Utility theory and risk preferences. Any doubts till now? Any questions? No doubts? There are some messages here. Okay. Thanks, Aziz. Utility theory and risk preferences. Utility theory first formally introduced by Daniel Bernoulli in 1738 through his paper Explosion of a New Theory on the Measurement of Risk provides a framework for understanding how individuals make decisions under uncertainty. So, initially, this was introduced by Daniel Bernoulli in 1783, 1738, okay, which talks about how utility theory and risk are connected to each other, and how people make decisions at times of uncertainty where things are not very clear. The theory was later expanded by John von Neumann and Oscar Morgenstern in their 1944 book Theory of Games on Economic Behavior, which laid the foundation for modern utility theory. So then it was worked upon by other people also, like Daniel Kahneman and Tversky also added to the utility theory. In economics and finance, utility refers to the situation, satisfaction, or benefit that a person derives from consuming a good or service, or in this case, from wealth. So basically, utility is that when you get some satisfaction from a product or from a service, or in case of finance, it will be wealth, right? You get satisfaction if you earn wealth, right? It is a way to measure how much happiness, satisfaction, or value someone gets from different levels of wealth or different financial outcomes. So, how you will get happiness from wealth? Obviously, when you make money, you feel happy, right? When you have money in your bank account, you are satisfied. You are like uh, more calm and composed, right? Instead of, if you do not have too much money, there will be situations where you will be irritated, you will not be feeling very great, right? So it does fulfills and satisfies you, right? For investors, utility helps explain why they might prefer a smaller but certain gain over a larger but uncertain gain, uncertain one. So for most people, if you're getting something for certain, say if I say that I'll give you, say, 500 rupees surely, and if I say I'll give you 10,000 rupees, but I'll do a lottery. Okay. So obviously most people will prefer to take that 500 rupees, although it is very small, but it is certain, right? uh, but there will be some people who will be also willing to take 10,000 rupees as a lottery, although the percentage win percentage can be only 10%, right? But most people will be risk averse and will like to have that short gain of 500 rupees over a say a probable gain of 10,000 rupees, right? Think of utility like this: if you had $1 lakh, gaining an additional $10,000 would provide some satisfaction. Right? So if you already have $1 lakh in your, say, bank account, and if you get 10,000 rupees, okay, it will give you some satisfaction for sure, sure, right? However, if you already had 10 million, that same $10,000 gain might not provide as much satisfaction. But if you already had $10 lakh, right, or $10 million in your account, then 10,000 is like 0.1% of that, right? So it will not give you that much satisfaction, right? Whereas $10,000 is 10% of your $1 lakh capital, right? So that will give you more satisfaction, more happiness, right? This is called marginal. This is called diminishing marginal utility. So your utility, when it comes, it diminishes the effect of it, basically. This concept helps explain why wealthy investors often become more conservative with their investors. As we discussed, that as your capital grows, you will switch to more capital preservation mode, right? So this basically describes that why if our capital is higher, we will prefer capital preservation than growth, right? This is because the utility they gain from additional wealth does not overweight the potential pain of losing what they already have. Okay. So whatever gain, the possible gain they have, okay, and whatever the pain they will occur where they lose a substantial portion of their capital, that will be much more than what they are getting, right? There are three types of risk preferences. Yeah, risk averse, risk neutral, and then risk seeking. Right? We'll take that one by one. Risk preference can be visualized through utility curves. These curves are called utility curves, which show the relationship between the wealth and satisfaction. That is utility. So wealth, which is, you can say, U is utility, U is for utility, W is for wealth. Okay, and then this, so y-axis is your utility or wealth. Okay, your x-axis is your wealth. Okay, sorry, your utility, your money basically. In these plots, the colored line is the utility of the gain to the individual. Imagine we have were given that for two examples. If you say have $5,000 for sure, sure thing with 100% probability of occurring. So you get, say, either you get $5,000 for sure, okay, or we do a coin toss. Okay, if heads comes in, then you get $10,000, which is a gamble of 50%, right? With a 50% probability, right? In a coin toss, getting a head is 50% probability, right? So this, if you see, you have zero initially. Okay, either you get $5,000, okay, for sure, or you get $10,000, but it's a 50% probability, right? So this $10,000 is a 50% probability. The gamble has 50% probability of winning and 50% probability of losing, right? So if you do a gamble, you may not get anything, or you may get $10,000. The utility of coin toss is basically U is your utility of, so gamble is zero point 0.5 multiplied by the utility, which is $10,000. Okay, plus zero point 0.5 multiplied by $0. So either you get $0 or you get $10,000. So that will be your utility. This results in gamble having halfway between the utility of receiving $10,000 and utility of receiving zero. So if you see here, okay, this orange line, okay, so this is for sure you're getting, okay, and this orange line is basically your $5,000. So it is, if you're getting $5,000 and here you're getting $10,000, so this will be somewhere in between. It will be, say, around, set $7,500, where uh, your utility is higher than getting $5,000. Okay, but you could have also get zero returns as well, right? So that is why it is somewhere in between. It is not the same as $5,000. Okay, it is little higher than that. Okay, but it is not the same as you're getting entire $10,000. We plot gamble halfway on each chart, that is y-axis. So this is basically halfway, okay, which will be a curve, right? The second is the neutral risk neutral risk preference, where risk covers investors show diminishing marginal utility as wealth increases. So what this is showing is the previous chart basically, is that risk covers investors will show a diminishing marginal utility as wealth increases. So if their capital increases, they will have a they will take less risk, right? They prefer a sure gain over a risky investment with a same expected value. So that if the expected value is same, they will take a sure gain option than to take a risky investment. Most investors fall into this category. Generally, most investors are risk averse. Okay. The plot of previous slide, that is in the figure displayed in the previous slide, that the sure thing has higher utility to a risk averse investor. So what we saw here is that the sure thing has a higher utility than the risk, right? The gamble will be 50% in between, say between 10 to 0, it will be somewhere in between, but the sure thing will have a higher utility, which is there to say, if you say in utility terms, it will say around 7.5, right? As displayed in figure in this slide, risk neutral investor show a linear relationship between the utility and the wealth. So if you see, this is a neutral risk where your utility is and your gamble is at the same point. It is not higher, right? So when you are risk neutral, then actually if you see, it is neutral, right? Because if you take a 50-50 possibility of a $10,000 or a zero return, and a short possibility of 5,000, it is actually the same, right? So a risk neutral investor will have same, uh, at at least theoretically will have same implications. They are indifferent between a sure gain and a risky investment with the same expected value. So here, if you see, the expected value was same, right? Either you get twice or you get nothing, right? Or you get short 5,000. So this is basically indifferent. If you say in terms of returns or the probability, right? But a risk averse investor would have taken this, right? A short gain of $5,000. The third is the risk-seeking investor. This figure here displays that risk-seeking investor show increasing marginal utility as wealth increases. So those investors which like to take higher risk, right? There are some people who like to take higher risk. Okay, will have increasing marginal utility. They prefer risky investment when a sure thing over a sure thing with the same expected value. So now here again the expected value is the same, right? If you see $5,000 or $10,000 or $0, both are actually the same, right? But they some risk taking investor will say, okay, I'll take a gamble, and okay, I which is have I'm not getting anything, right? So I'll not take a sure shot $5,000. I'll take a risk and try to get $10,000 instead of $5,000, right? So risk seeking investor, but when your capital is basically small, you will try to take risk, right? So here it is an increasing marginal utility, because if you see, this curve is increasing, right? That is why it is called increasing marginal utility. Everybody, this is clear? Any doubts here? Okay, thanks. Sure. Okay. Practical application of risk preference. Understanding utility theory helps in finance, right? Especially in portfolio construction, risk assessment, and decision making, obviously, right? Portfolio construction is basically by matching investment strategies to individual risk tolerance. So, uh, you know your risk tolerance, okay, and based on that, you can construct your portfolio, right? Whether you want to invest, say, like what we discussed here, right? 60% conservative, 30% moderate growth, or 10% aggressive growth, right? So if you want to take higher risk, you can increase this to 70 or 80% also, right? And reduce these. Or if you are taking lesser risk, you can reduce this, you can increase this to say 70, 80%, and reduce this. Or if you're taking more risk, then you can increase these two and reduce this, right? You know, if you know margin utility, then you can do that, right? Yeah, as of now, it is similar to what we have already done in behavioral finance. Yeah, risk assessment, quantifying risk tolerance in mathematical terms. So this helps us to measure risk and know mathematically that how much risk can happen, right? And that is very important. You should know that how much risk are you taking. Like if your capital is at 10 lakh rupees, then how much are you taking risk, right? If you can know that, then always you can control it. And obviously it helps us in decision making, because if you know your returns, if you know your risk, then you can know where to invest how much. Providing a framework for evaluating investment choices. So that gives us, say, which investment options we can take. Okay, how much we can invest. Okay, all those things can be thought about. For example, a risk averse investor might prefer a portfolio of 60% bonds and 40% stocks, right? So he's taking higher risk. He's putting sorry, he's taking lower risk because he's risk averse. So he's putting more money into bonds and less money into riskier asset like stocks. While a risk-seeking investor might opt for 90% stocks and 10% bonds. So if you want to take more risk, then you put say 90% or even 100% you can invest in stocks, right? Even though they have the same risk investment horizon and same financial goals. So although their risk or their financial goals may be the same, their investment horizons may be same, but because their nature is different, they can opt different portfolio, right? Recent research by Kahneman and Tversky expanded a classical utility theory through prospect theory, which better accounts for how people actually make decisions under uncertain versus how they should theoretically make them. Right. So we did that, I think, in prospect theory level two. Okay, where it explains in a better way how people take risk. Right. At least theoretically. Types of risk. This is a lengthy topic, but at least we complete few slides. Types of risk. Investors face various types of risk when participating in financial markets. There are various risk, or what we can say is that the risk can be divided into various sections. Okay, to understand them better. Understanding these risks and implementing appropriate mitigation strategies is crucial for successful portfolio management and investment outcomes. So, understanding risk is exceptionally important. With the help of that, you can know how to mitigate them, how you can manage them, and say limit them. Right? You can avoid them, but you can manage them. Right? Here is a comprehensive overview of the main types of risk investor encounter. So these are most of the typical types of risk which you may encounter in most cases. First is the risk or the systematic risk. We know that market risk and systematic risk cannot be reduced by diversification, right? The risk of loss is due to factor affecting the overall market performance. So even if you diversify, if the entire market is falling, then diversification will not help. Some of the examples are economic recessions. If the country goes into economic recession, then the entire market will fall. Even the bond market will fall, and uh, equities also go down, right? Or there's a significant change in interest rate policies, or interest rate increases substantially. Then there's a risk, right? And it will affect most of the sectors in the market, right? Then political events or natural disasters, say political things can be very very uncertain, right? uh, Governments can lose elections, and all those things can happen. They can take irrational decisions at times. Okay, and obviously natural disasters can happen, like tsunami, earthquake, all those things, whatever, right? Floods, all those things are beyond our control, right? So these things will affect generally the entire market, or at least say multiple sectors, right? Because like a natural calamity like COVID type of thing affected most of the sectors, but did not affected medical sector, right? So it will affect most of the sectors, or and a lot of sectors, but it may not affect all the sectors, right? There can be some events like that. Okay. How we can mitigate them? Market risk is undiversifiable, so this risk you cannot mitigate by diversification, right? In a widespread financial panic, all sectors of the market tend to fall. The only safe haven is cash. Okay? So generally, in something like 2008 financial crisis, or like in COVID also, at least initially, if you see COVID March low, every sector, even the medical sector or the health care sector, also went down. Then after that, it recovered and it was the first to recover. But initially, when it fell, everything fell, right? Same way in financial crisis also, everything fell initially, and then some sectors will fall less, some sectors will fall more. That will depend upon the crisis at that time. So each crisis can be different, right? Sometimes it can be because of finance, sometimes it can be because of, say, a medical issue like a COVID, sometimes it can be something else, right? So what is the reason and how it is affecting which sector? uh, because of that, some sectors may not fall too much or may outperform, and some sectors will perform badly, right? So depending upon how much it affects to an individual sector. What we can use is instruments like options can be used too, because say if you see the market is falling, you can buy puts so that you can hedge and your losses can be mitigated, right? Or you can buy futures if you have very high. Say what I like to do is, since the time mid cap index have come in, I know that most of my securities will be in mid cap. Say most of my investment will be in mid cap, so I will buy a few lots of mid cap futures, right? I'll sell few lots of mid cap futures, because it matches with my risk investment, this thing. So with futures and options, you can hedge and protect your portfolio. Nifty was not a very good instrument for hedging, because at times when mid caps fall, Nifty may not fall, right? Because it's made of top 50 stocks, or say any benchmark. Okay, if you see of any country, generally investments are in mid caps and small caps, and the index is different, right? Like I was saying, sir, mitigation one, first 3 points is in our book. Rest don't we? Yeah, yeah. These are my. I have added them. That is why I put it in blue. They are not in your this thing. Okay, so Aziz said, can we take a break of 5 minutes? Aziz, we will close up in 5-10 minutes only, because 8:30, 8:40 will end up any which ways, right? So we can just continue for another 5, 10, 20 minutes, whatever. Okay. Generally, we like to keep these sessions to limited to 2.5 hours. Okay. Because the content has reduced, so I don't think we will need that much time. Okay. Previously we used to have 3 hour sessions. uh, Thanks that the content has been reduced, so we may not need that going forward. Okay. Another way of mitigating is dollar cost averaging. There is a major crash in the market is an opportunity to increase position size if the capital is available. So, this is some people, especially value investors and fundamental investors, use this, right? That if there's a crash, or you are buying good quality stocks much cheaper, right? So that can be one way of thinking. I personally am not in that opinion. Okay, because I'm not a fundamental investor. I do not see fundamentals. Okay, I'm a trend follower. So I don't use this, but there are many people who use it, and don't say it is wrong. Okay, if you can take that risk, because say if you are, say, buying something thinking that, okay, it was getting, you are getting it for say 100 rupees, now it has come down to say 50 rupees. Okay, you are thinking that you have got it cheaper by 50%, but understand that your risk is still the same, because if you would have put, say, 1 lakh rupees in that particular stock at say 100 rupees, now if you're putting 1 lakh rupees at 50 rupees, if the stock goes down from 50 to say 25, you are still losing 50%, right? So are you ready to take that 50% risk? Personally, I am not of that person which will take that much risk. And generally these things, you cannot keep a stop loss. Okay, so your risk is generally high in dollar cost averaging. Okay, but it's person to person. I will not say that you don't do it. Okay, if you can handle it, you can do it. Okay. Other, as I said, others are other options are by I've added them. Okay, multi-class strategy. Basically, multi-asset class strategy is basically, see, understand one thing is that when there's panic, it's not as everything is falling. There will be something which will be rising. Okay, like if you see 2008 crisis, just go down and see the charts. The gold was rising at some point, a dollar was rising at some point. Okay, so if you have shifted your capital from say equities or bonds to dollar or gold, you would have done substantially well. Okay, you would have made money instead of losing it, right? Bonds were not performing, bonds were also cracking at that point of time, but then you should have that much understanding. Okay, you must have a strategy for it. Okay, so it's if you don't have a strategy, then it will be a concern. um, I did made a What I will do is that I'll try to make a back test and show you how this multi-class strategy reduces your risk. Just next week. Now we will meet after 3 weeks. So um, in that, I'll try to show you how this multi-class strategy can reduce your risk substantially. Okay, in the on with backtest I can show you that. Okay, I cannot find this chapter in 2004. Yeah, it is not there in 2004. It is in 2005 correctly. Yeah, Kunal, this is not in 2004 correctly. This thing. Okay. Multi time frame strategy. Now again, understand what happens if you have a strategy. Okay. Say you have a strategy in say daily time frame, and but it is possible that in daily time frame the markets are down, but maybe in some other time frame, maybe in weekly it is up, or maybe in monthly it is up, or maybe in 5 minutes or 10 minutes it is up, right? So although your daily strategy will be losing money, but your 5 minute strategy, your 20-minute strategy, your weekly strategy may be having some trend, right? And also understand that you can have build a long shot strategy where uh, you make money in the downside also, right? If you see right now the markets are falling, at least Indian markets are falling in the last say 1 2 months, right? If you have a short strategy, okay, although your long strategy is losing money but your short strategy is making money, so you can at least mitigate your risk of your long strategy, right, by having a short strategy or by having a strategy which is long and short both, because that is what we do. Okay, uh, we do not depend only on one direction of the markets. Yeah, and then you can have multi-instrument strategy, like you have multiple strategies, one in cash market, one in futures market, one is options market. Okay, so different instruments are there. So maybe like if your cash strategy is losing money, your option strategy is making money, or your volatility based strategy is making money, your theta decay strategy is making money. So you can diversify into strategies which are non-correlated with each other, and that will mitigate your risk. Okay. Then in strategies for different phases, like trend following strategy with a mean running with a mean reverting strategy. So we know that trend following strategy will lose money in sideways market, right? So you can have a strategy which is trend following. Along with that, you also have a strategy which is mean reverting. So when trend following is making money, mean reverting may be losing money, but overall they are still making money together, because both strategies have positive expectancy, right? Understand that both studies should have positive expectancy, and so they will help each other. When one is losing, another is making money, so your entire portfolio is not losing too much, or it is, in fact, it can be making money also. right? Same way when mean reverting is making money, maybe trend following is losing money, right? But in totality, you are not losing too much, or you are making money also, right? So with these things, you can mitigate your risk. This systematic risk also that can be mitigated, right? Company specific risk, that is unsystematic risk. So company strategic risk is unsystematic, and you can uh, mm, oh sorry may you explain one or last more on last point? Okay. uh, say trend following strategy. Say, let me show you this on chart. Okay. Let's think about, I'll show you few stocks. Think about them as your equity curve of your strategy. Okay. uh, okay, if you take this stock, okay, in the last say six odd months, it has been sideways. Okay. Suppose this is, if you are running a mean reverting strategy on this. Okay. You try to buy here, sell here, buy here, sell here. It's not easy. Okay. Or let me go to something which is more this thing. Okay. You see this phase. Yeah. Yeah. This is a typical mean reverting market, right? Where there's a range. Okay. Where market is not going below this, market is not going above this, right? If you are running a mean reverting strategy on this, so you will buy somewhere here. Okay. You'll sell somewhere here. You'll buy somewhere here. It's not that easy. You'll have to have a good strategy. But for example, you'll sell somewhere here. You'll buy somewhere here. Okay. You'll sell somewhere here. Right. So in mean reversion, you are trying to do that, right? And this will make money. And along with that, you have another strategy which is trend following, which is like something like say trend. Yeah, in the same phase, this stuff is trending up, right? Or maybe you can say it's trending down. Okay, September was the period, right? So say you are running a short strategy, since this stock is also in futures. Okay, so you will be making money in the short side. This is trend following, right? Trend is down, you are making money in this trend. Okay, so um, at point where market is sideways, you are making money in that sideways market. But maybe here you are losing money, right? Because here there's no trend, like it was up, now it turned down. In this phase you will actually be losing money, because you didn't know whether the trend will turn down from here on, right? So here you will be losing money in the trend following strategy. You would have been long in this, and you will be losing money in this, right? But in the mean reverting security, okay, you will be making money in that. It's that market was sideways. Okay, so you will be making money in that. So in totality, if both strategies have a positive expectancy, you will make money. Correct. Now this is trending. Now from here on, suppose the market is down, right? and you got a short trade, and it is making money in this short move, right? So now your mean average is not making money, but this trend following is making money on the short side or on the long side, whatever. So when you run these two strategies together, since both of them has positive expectancy, they will make money in the long run, right? But when this strategy is losing money, that strategy was making money. When that strategy was losing money, this strategy is making money, right? So your combined equity curve of your total asset, total money under management will be smoother. Your risk will be mitigated. Now you're getting it, Anshuman? Okay. I'll try to show these things with equity curves, but it will be difficult. Okay. But I'll try to show it. Okay. Going forward, if we get time, I'll show you. If you understand it practically, then you will remember it. We'll just complete this one slide and then we'll wind up for the day. Okay. Company specific risk or systematic risk. Okay. So these are basically, say if you're investing in one stock, okay, then that stock, because of its own reasons, can go down, right? These are risk unique to a specific company or investment. So it can be like, say if you invest in, say Yes Bank, okay, and it goes down. So other market is going up, but this goes down. So this can be reduced by diversification, right? So you keep a limited capital, only 1% or 2% you're invested in, yes, say Yes Bank. Okay, so even if it goes down, but other things are doing good, so your overall portfolio will not be affected much, right? So you, this is something which you can reduce by diversification. Okay. Or say you have some investment in equity, some investment in gold, some investment in real estate, some investment in bonds. Okay, so equity is going down, but gold is going up. So you, since you're diversified, that risk is reduced. Okay, so this is a specific risk specific to a certain investment. Or say you're invested in, say, bonds. Okay, and say DHFL bonds fell. Okay, DHFL went bankrupt and DHFL bonds went down. But you had not invested only in DHFL bonds. You had invested in LNT bonds also. You are invested in HDFC Bank also. You are invested in Standard Chartered Bank also, bonds also. So your risk is unsystematic. It is specific to that particular one or two instruments or securities. The examples are management changes. So such risk can happen because some major management changes, some big CEO which was very dynamic goes away. Okay, or they came to a new product. They came up with a new product, but that became a failure. That did not work out. Or sometimes some product can become obsolete, right? Like pagers. If a company is dealing only in pages and pages become obsolete, then obviously that company will become bankrupt. This happened with Kodak, right? Cameras became obsolete because of mobile phone having cameras, right? So Kodak became say down, right? So product failed, right? Legal issues can happen sometimes. Say I remember, uh, yeah, one company in India is there, IGL. Okay, it's not legal actually, but I'll just show you the chart. It was not a legal issue. It was some actually, um, what we say, government policy issue in 2016, somewhere 16 or 14. Yeah, this fall. Yeah. IGL is into gas transmission or something like that. Okay, so if you see this one day, it fell down by 33%. Okay, this was a news which came in that government has put some litigation that they cannot sell beyond this percentage or this to be. It is in Delhi, so anybody who is in Delhi must be knowing about it. Okay, they cannot sell gas beyond this particular rate, or they cannot have this much more than this much profit or something like that. They came up with. Okay, so this was specific to this company. In this day, on this day, if you see, no other stock fell like this. Okay, this was 2012, some 4th October 2012. Okay, no other stock fell like this. But because it was specific to this particular company, because some government announcement or because of any XYZ reason, okay, the stock fell down by 30% one day, and in few days it went almost like 50%. From 38 it came down to 20, less than 20, right? So more than 50% in a few days, right? So this is company specific risk, right? It can be because of legal issues, some litigation. Many times in drug pharma companies, there's a US FDA, something comes in, right? So something can happen, or some case can come in onto a company, or some income tax or GST, this thing when can come. So all these things can come. Because of that, the company can convert from a profitable to a loss-making company, right? So these things are stock specific, okay, or it can even they are dependent on upon one particular event. Competition impacts, so it can happen that a very big giant like Reliance comes into the field. Then also this happens like when Geo came in, Reliance communication what was beaten down drastically, because Geo took a major of his it was a major computer, right? We know that Reliance, where whichever industry it goes, it disrupts the industry, right? So if something like that big giant comes into the industry, then it becomes a problem, right? So competition can have a big major impact on the business of the entire company. How we can mitigate this? Okay, so diversification across different companies. So this we discuss that unsystematic risk on company specific risk can be reduced by diversification. You do not have just investment in one particular stock or two particular stocks. Okay, you have at least 20, 30 stocks in your portfolio. Okay, then obviously even if one stock goes down by 50% like IGL, it will not affect too much to your portfolio, right? Thorough financial fundamental analysis. So if you do fundamental analysis properly, say still some things you will never be able to predict, but fundamental analysis can definitely help you avoid most of the situations. Okay, so out of 10, at least 8 can be avoided by investing in those companies which are fundamentally strong. If you know that the company doesn't has too much of a debt, if the company's products are very strong, like HUL, okay, you know that HUL's products are very very strong. They have multiple, so more than 200-300 products. So then even if one product fails, it will not matter, right? You know that the management is good. So by these things, you can mitigate a lot of risk, right? Regular monitoring of company news. So whichever stocks you have investment or you have interest, you keep having some watch of some major announcements about those companies. Okay, and if there is something important, you should be able to have that understanding that okay, this news will impact how much to this stock. Okay, so this will come with experience. Nobody can teach you, I think, this thing. Okay, that this news will have how much impact on a particular stock. Setting positions has limits. Okay, so what you can do is that suppose you uh, have 20 stocks in your portfolio, right? But you do pyramiding. Okay, you keep adding when you are in profit. Then you can keep a limit of it. Say, I will not put more than 10% of my entire capital into one security. Okay. So because if with pyramiding, you can even increase your position size to very, very high levels. Okay. But if you have kept a limit to the position size, okay, then your risk is always limited. Okay. So that it doesn't happen that if that stock which is having the highest size in your portfolio, if that cracks, say 30, 40, 50%, then it should not impact too much into your portfolio, right? So you can have position size limits and setting stop losses. Like say if something like IGL happens, if you have a stop loss, okay, it will cut your trade at 33%, right? Loss, but at least it will cut. So even if your stop loss would have triggered on this day, you would have lost say 33% on one day, right? Or maybe you have invested somewhere here, you would have got say 40% loss or 50% loss, but still you would have saved this from say from 22 rupees to 80 rupees. You would have saved that fall at least, right? So by keeping a stop loss, you can mitigate big losses, when losses can be say 30%, 40%. You should not go to those levels. Generally your losses should not be in cash market. I'm talking about, okay, it should not go beyond 20% most cases. Like one or two can go because there can be a 20% down circuit, can't help it, okay, or something like this. Suddenly it goes down to 33% one day, can't help it. But in most cases, your losses should not go beyond 15 to 20%. Like if you keep a stop loss, generally that will not happen, right? Okay, with this, we'll wind up for the day. Any doubts, any questions? And we'll meet tomorrow morning, 10 a.m. and we'll continue from here. Sir, the whole curriculum change or just some part I have that I need. Kunal, you're not giving exam in June? You are giving in June, right? So you have registered for the exam, right? Or not? Then you will get it on the portal. Na? Log into your CMT portal, go to my CMT. There you will see curriculum. Okay, Anshuman, can you show him where he'll find my curriculum? Can you share your screen or anybody else? Just log into CMT curriculum, CMT website, okay, and there you will, and in
No,
my
it is
CMT you
share
will see.
screen is disable actually. It is disable.
I'll give
Not
you the right one
share
second.
screen.
I'll give you the right one second. I'll stop sharing and I'll give you. Uh, Raghav is saying after class, can we discuss regarding current scenario in the market? We can discuss little bit, but Raghav, now the SEBI has come that even for the education, you cannot talk about recent stocks and all those things. Okay, so we will be limiting a little bit on that. Okay, how should I give you the right? One second. Uh, make I'll make you co-host. Okay. Now, Anshu, you are the co-host. Can you share now your screen? Acha, Kunal has got it. Kunal, can you see it now? Anshu is showing for others also, so that you can anybody who doesn't know. Still, I cannot see your screen, Anshuman. Maybe it's little slow. Yeah, now we can see. Okay, so here if you see CMD curriculum, when you go to my CMT, you will see CMD curriculum. It will take some time to load. Okay, so here you can see it. You can just click on each topic, and then you can go to any specific topic wherever you want. Okay, types of risk, and then you can see the curriculum. Okay, thanks, Anshuman. Because I haven't got the curriculum till now, so I can't show you. That's why, yeah, I told Anshuman. Okay. So we'll meet tomorrow 10 a.m. Anything, Acha, you wanted to discuss about current market scenario? Okay, so it's been bearish only. Uh, uh, if you see, I'll just show you something. I'll share my screen. Okay. Okay. What I give a lot of importance to, I'll just show you that. Okay. Uh, I'll go to Nifty. Where's Nifty? Okay. Today's data is not updated. I'll just update it. Okay. So this is Nifty, and I'll just run. So what I give a lot of importance to breath analysis. We have done it breath analysis level 1 and level 2 also. Okay, I give that a lot of weightage. Okay, so I'll run this yearly high low index, which I recently added into the one video also of that. Okay, I'll change this to CNX 500. Okay, and that's it. I'll run it. Now, if you see this panel, okay, I'll remove others as of now. Okay, I'll remove others. Okay. These are the above stock which are making new 50-week lows. Okay, so basically net or what I'll do is I'll make this individual, but also okay, I'll run this also. Okay, so if you see here, there are 500 stocks is shared at 500. We know that, right? Now, if you see here, uh, the number of stocks which are making new 50 lows was 73 here. Okay. And then the number of stock making new 50 week high was 3. So net there was 70 stocks which were making more new 50 week lows. Here again, it went up to 72, and this was say zero stocks were making new 50-week highs. Okay, and here recently, if you see, it went to 107. This is 107, and zero stock making 50-week highs. And same thing here. If you see today, there were 100 and 100 stocks again. Okay, so this was 107. This is 100. Okay, and one stock has made new 50-week high. Out of CNS 5, only one stock has made new 50-week high. So what this is showing is that the market is not healthy, right? If the economy is doing good, then a lot of stocks should not make new lows, right? Not yearly lows. Like it's last 1 year they're making. Anybody understand 50-week lows? Why it is important is because anybody who have invested in these 100 stocks would have been in loss in the last 1 year. Anybody who have entered into those 100 stocks in the last 1 year would have been be in loss, right? And that thing will create panic. Okay, panics don't come when you are in profits, right? If you are in profit and the stock is going gone up, you are comfortable because you still have some money, some cushion. If it, even it falls, you have some profit. So okay, your profit will be eroded, but at least you will not be in loss. But when you are in loss, Okay, and if you say I have not run it, but you I can run it and show you also. There will be a lot of stocks in this FTSE and 500 which has made more than 40% loss. Okay, if they are down 40% from the 52-week highs. Okay, so this is showing that a lot of stocks are not performing. Only few stocks are holding off. Okay, at one point of time, my portfolio had 150 stocks. Now it has only seven stocks. Okay, believe me, only seven stocks. Okay, so this generally shows that the market is not healthy. Okay, so this is one thing which I keep a lot of eye on. Okay, this is a breath indicator. Yes, Raga, we are into oversold levels, so it is possible that we get uh, a bounce. Okay, but when this happens for the first time, like here it happened for the first time, right? After so many years, like here, 70 stocks were making new 50-week lows. Again, net. When did it happen last? Okay, somewhere in 2023, but it did not went to those levels, but it did went to minus 50 stocks. Okay, so even if we take this, after 1 year this has happened. Okay, see the extent of this move and see the extent of this move. Okay, in the last 1 year it never happened. So it was there was that it is not, the market is not healthy and it is going to correct more. Okay, at least at this point it was very evident. Okay, that market is not healthy, right? Now you can say that okay, it is getting support at these levels, the bottoms are somewhere here, it is taking support at these levels. Okay, but I still feel that if the economy is good, say there's no sector which is not down. I'm not seeing every sector, but there's no sector which is not down by at least 10 to 15%. I don't think so. Technology is down, pharma is down, FMCG is down. Even the defensives are not spared. Generally, what will happen in a healthier market or in a little bit of a decent market, at least some sector will stand out, right? Either utility or FMCG or pharma or the technology. Here, this time, no sector is spared. So that is giving me more doubts that even if there is a bounce from this, yes, it is oversold, so there can be a bounce from this point. Okay, but I think still the market is there's more room to go down. Okay, it can go bounce from here, it can be a bottom also, I cannot deny that. Okay, but I am more towards like bearish side. Long side is difficult as of now. Okay, yes, if you get good buys, you can. Okay, but as of now, I'm short in the market, and very few stocks I have in my portfolio. Only seven stocks are there in my portfolio, that's it. Yeah. Nifty mid cap and small cap index zero return in the, yeah, almost. If you see, it won't be zero, I suppose. If you say index wise, I don't think it will be zero. But it will be like say 1 year will be Feb. Yeah, almost. Yeah, you are right. Almost zero return in most cases. Yes. Yeah. So now if it breaks these levels, okay, understand. Okay, if it breaks these levels, we don't know whether it will or it will not. Okay, then everybody say most people will be actually in a loss of entered in last 1 year. So all those late entrants to this 4 year bull market which started from COVID, okay, will have a severe pain, and they have not seen such market. They have not expected, they had not expected this, right? So initially they will be like non-acceptance of this, and then if it continues, I don't know whether it will continue or not, but if it continues, then there will be severe pain, and then they will throw away their towels and sell everything at whatever price. Okay, I don't know that is going to happen or not. Okay, but such things happen. Okay, so you should be ready for the worst. Market, let market show. No, few stocks make new 50 week highs. If it is healthy, few stocks should make new 50 week highs, right? If not, then say new highs are made by the indexes when the stocks make new highs, right? If the market is doing good, some stocks should do good, right? Yeah, rest of the market are at highs, mainly US. If you see, mainly US. But I don't know about the. I've not seen actually, but I think Japan is not at new highs. I'm not sure about Europe. Okay, China is not at new highs. Um, and I'm not sure about other markets. I've not seen them. Yeah. So, but see, it happens. I'm not saying it's a bear market. As of now, if you see the bear market definition by Dow, Charles Dow, is that there has to be a fall of 20%, then a rise of 10%, then that 20% low has to be broken, right? So that has still not happened. Okay, but at least I would say the trend is down. Yeah, even Nifty, if it survives, okay, I don't think mid cap and small cap will survive. Okay, I think they will continue to bleed. At least that is what I'm expecting. Okay, I may be wrong. Okay, but that is what I'm expecting. Here, if there is support. You can see there is support at these levels in Nifty also, in mid cap Nifty also, maybe in other indexes also. You may be finding some support at these levels. Okay, there can be some bounce, but I am bearish. Okay, in on Indian market, and there will be some markets which will lead the fall. There will be some market will lag. So maybe India is leading this fall. Okay, yeah, US and UK are yes very correlated if you see. So yes, UK could have been making even Germany and France, maybe Europe, maybe also making new highs. Okay, because whatever is happening, like this tariff wars and everything, is generally between US and China and US and India mainly. If you see, so you don't know. Okay, be ready for the worst. Okay, at least let this come above -20. Okay, I will not invest in at least till it is like below zero or below -20. Yeah. So okay, let's see. But overall market is not. I'm not comfortable going longs in this market. Even if you take other breath indicators, uh, like say for this is like 200-day golden cross using an EMA. Yeah, I'll go back to Nifty. Okay. And yeah, so this is say golden cross. Generally, this is very slow indicator. Okay, so still it is down. So you can see that most stocks are like crossing death, making death crosses, right? Um, Another indicator which is good is arms index. I don't think arms index is giving anything important as of now, but let's see. I've not checked it for the last 2 3 days. Okay. You see, this is like it gave you a warning here. Arms index, what I see is whenever it goes above 4, is an indication of a substantial correction. And if you see, it gave you one above 4 indication here and another here. If you see before that, it for the last 2 3 years, it has not given any indication above 4 levels. Here it was there in 2003, and it, if you see, the market went down after that. Okay, and here it gave in somewhere in say August somewhere. Sorry, June somewhere maybe. No. April, sorry, and here again it gave you another indication in September, so August here. Okay. But if you see, it rarely goes above 4, and whenever it goes above 4, there is generally a lot of correction. Okay. You see here, this was again, okay. After that, the market came down, not substantially, but it did came down. Okay, and this is COVID. Okay, if you see, just before COVID, it did give you an indication. Arms index is a very good indicator. You see, somewhere at around 11,000 levels, it gave you an indication of very high levels of, say, 10 levels. Okay, so these are warning signs. Whenever it goes above 4, it's a warning sign. Okay. Before that, also, if you see here, also, it did give an indication. Okay. Although it continued to go higher slowly. Okay, but if you see, mid caps, small caps were still be bleeding in this rise. Okay, so arm index is not showing anything recently, but it did show you in April and this September. Another good indicator which I look is, yeah, this one, 200-day high low, no, not this one. Where is it? Yeah, this is good for buying. When to start buying? Okay. Number of stocks below 200-day. I'll remove this. I'll remove this. I'll remove this. Okay. So if you see here, it has gone below 20. 20 is an important line. Whenever it goes below 20 and then comes above 20 is a good time to buy. You see, it went below 20 and came about 20, so that was a good time to buy. Okay. If you see COVID, when it went below 20, okay, and then it when it rise above 20, okay, so that was a good time to buy. So I will look at this indicator. It has gone below 20. Now, when it comes about 20, say here, it went about 20 here and here, maybe the major move happened here. So if you see after COVID, it came below 20 somewhere at around 9,500 levels. Okay. And rose above that somewhere at same levels. But this was the entry time. This was not the entry time. You would have been in pain if you, although the levels are same when it came below 20 and went above 20, but this is the time to enter. Okay, so this the number of stocks which are say below 200-day moving average, when it goes below 20, and then if here also this was 2018 correction here again, when it went, sometimes it did gives you a false this thing also. Okay, but even if you lose money in this, it's fine. If you're getting this entry, I will not mind taking it. Okay, you will get some false trades with this. Okay, but if you see here also, this was 2016 correction. Okay, uh, it was a false trade here also, but when it goes below 20 and then rises above 20, generally major bottoms are found there. Okay, so I'll wait for it again here also. 2013, it went below 20, came out 20. That was a very good place to buy. Okay, so this is something which I keep in mind. Again here, this is somewhere here. If you see, it did give you a false here. Okay, but then yeah, this again give you a very good entry levels. Yeah, yeah, this is again good entry levels. Although it sometimes it will give you false trades. Okay, that is fine. Okay, no indicator will not give you false trades. Okay. And this was 2008. If you see, the entire 2008, although it did give you a bit of false here, okay, but if you see, it went below 50, 20 somewhere here. It did came above that, give you a false entry here. Okay, but from here till here, almost entirely went remained below 20 in this entire. So you would have avoided this major fall, okay, if you would have followed this indicator. And when it came above 20, if you see that that was a new rise. So even if you have avoided this phase of market, then even if you have say entered here and then exited again, because your stop loss would have been hit it. Okay, here it was say around 4,500 and this was around 2,500. So almost 2,000 points, which is like 40% correction from 4,500 to 2,500, right? You would have avoided this. So these are not times. These are time not to be invested in the market, in the equity market, basically. Okay. So till the time it is below to 20, I will not be entering. Okay, but if it rises 20, it is worth taking the risk because you will get stocks at good levels to buy. Although little higher than the exact bottom, but that is fine. It will not matter if you buy 10-20% higher. Uh, if your target is say 50-100% return, then 50, 20-30% higher buying is not a problem. At least for me, it's not a problem. So these are the signs which I look mainly. Okay, these are some indicators. Trend arms index, this 200-day moving average index, and the high low index basically. Okay, so we'll wind up for the day, and we'll meet tomorrow 10 a.m. Okay.